Hello world, welcome to Farm the Market. On the Stock Trading Journal series, I share with you some of my trades. I will not explain a given strategy in depth or claim that I have the quote-unquote epic strategy that beats the market every time. I just hope it's a good exercise for me where I get to analyze some of my trades deeply by explaining them to you. After all, you know what they say. If you want to understand something well, try to explain it simply. And hopefully for you, by looking step by step at examples of real trades, you might find interesting some of the techniques or adjustments I use on my trades. And this might help you in your journey to develop your own trading skills. This time I will not talk about a particular position, rather a warning signal that I consider relevant and made me close most of my individual short-term positions on Friday. Let's get started. Context. Everybody knows the market has been volatile and very choppy in recent weeks. As it always happens, abusing the monetary policy has consequences, and inflation finally is forcing the Fed to broadcast a change on its policy. They are obviously very late to the party, and a soft landing, or however you want to call a calm transition, is not happening. To the contrary, things will get very messy, and the stock market will suffer. There will be huge moves, and there's no script about how the sequence of events will happen exactly. So, as every market participant is trying to position for the coming weeks and months based on their own assumptions, the market will continue to be unstable to say the least. What does this mean exactly for the S&P 500? A 15% correction? 20%? So, a bear market? If so, for how long? I don't know about you, but I suck at predictions, so I don't even bother. My approach is to just deal with what is in front of me. So, what is in front of us? If you have watched some of my other videos, you will know by now that I often use the structure of the VIX futures curve as a relevant indicator for market sentiment in the short term. As a brief recap, under normal market conditions, the structure of the curve will be in what is known as contango. This means that as you go further out in time, the value of each future increases. These values represent volatility. You would expect that given more time, the probability of an adverse event increases and therefore, the value should go up the further you move to the right along the time axis. When the curve inverts and the short-term values are higher than the long-term values, the curve is in what is known as backwardation. So, it's relevant when the curve inverts, and I think that tells you a lot of what big players in the markets are expecting in the short term. There's no one magic indicator that can tell you everything you need to know. But as a rule of thumb indicator, I pay close attention to this one. You can dissect the curve in many ways and extract valuable information from it. As I have mentioned in the past, in general my first approach is to look at the first 2 months. This time around, although close, the first contract, let's call it F1, is still below the second contract, F2. So, can we really talk about full backwardation? I think so. The reason being that F1 is very close to expiry. So, the weight it has is pretty much negligible. I would really focus on F2 and F3 to find out what the market is telling me about the short term, and it doesn't look good. Okay, all that theory sounds interesting and all, but this is the Stock Trading Journal series. How does this apply to trading? Whenever I open an individual position, it should have enough merits to stand on its own, with its own setup, risk-reward ratio, stop loss, etc. But I cannot be oblivious to the market in general. The headwinds might be too strong. So, when the VIX curve behaves like it is right now, it's sort of an oh shit moment for me. With all that in mind, what I decided to do on Friday was to override the individual stop losses and targets of each position and just close or reduce all my long individual stock positions. All the positions had the same weight within the portfolio when they were opened. Within the positions I closed completely, some of them were already very close to their stop loss level, one was pretty much at break even, and the others were already in positive territory. Regardless, they had to go. The environment is just not right at the moment. Looking at the numbers, one might say it wasn't really a hard decision since overall the positions were pretty much in break-even territory or just a small loss. That obviously helps. Mental health-wise, it will always be easier to take a decision when you are closer to break-even rather than at a big loss. But I would have closed all those positions regardless. Regarding the other 3 stocks that I only decided to close half the position, I think we can see a common theme here. All are in the commodities sector. Oil and iron, to be more specific. I see a lot of strength on those sectors, so I didn't want to completely lose those positions. And obviously, taking some profits off the table doesn't hurt. Even if the market takes a turn for the worst, I expect these sectors to be a bit more resilient. So, taking half the position off for now seemed prudent. Also, I read once that working in halves when managing positions helps you at a psychological level. I find it to be true. You are always equally right or equally wrong, so that helps to minimize second guessing. There you have it! A different take on the stock market trading journal series this time. A broader approach instead of a detailed example about a trade. I hope you found it interesting. Markets might bounce back on Monday or go down further, who knows? But I think this approach is sound and has helped me during the years to efficiently mitigate risk. If the position set up again nicely, I can always go back in. Also, it will help me to sleep better during the weekend and enjoy the Super Bowl without staring at the future screen during the game. I hope you found this video interesting. Please remember to like and subscribe. Thanks for your time.